Welcome to the Titans of Industry show. I'm here with Dave Kranzler of investmentresearchdynamics.com. Dave runs a mining stocks and bullion fund, and he runs this popular blog, and I follow his work for a long time now. We've had a discussion prior to this interview, and what we want to do today is something special. We've never done this before, and it takes someone at the caliber of Dave Kranzler to really deliver what I want to give you today. This is a very important interview. I hope you listen to it again and again. It's going to be very informative. What we're going to do today is we're going to do an analysis, a 20-minute analysis of a company. We're going to go with Barrick Gold, a company that I don't recommend at all buying right now. It's overvalued in my opinion. We'll see what Dave thinks of it. But what I want you to do is get inside the head of Dave Kranzler, who's done this countless times. That's what he does for a living, and he's done it for more than a decade, right? Analyzing mining stocks, and he's running an actual mining stocks fund. So I'm very pleased to have an opportunity to peek inside his head. And you know, if you know Dave, he doesn't mince words. He's a straight shooter. You're gonna get brutal honesty, and I love that. And I want to give this analysis to you, and I'm very glad that Dave has kindly allowed us to share his proprietary analysis that has worked for him so well and for his clients. Dave, how are you?
I'm doing well, thank you. Thanks for having me on your show.
I'm very glad that we can do this. It's very exciting. I don't remember ever getting the chance to listen in on an interview where an actual analyst goes in depth of a company. We're going to do Barrick Gold just because it's the largest miner in the world, and honestly, it wouldn't hurt to see what you think about the company right now. So where would we begin this kind of analysis, Dave?
Well, that's an interesting question, and Barrick is the kind of company that you can spend hours on because there's so many parts to the whole. And I'm familiar with Barrick because I've been doing this sector, analyzing it, researching it, investing in it now since late 2001, so over 16 years, or around 16 years. And I've really never been a fan of Barrick. I think it's kind of like General Motors. It's become just a giant sprawling bureaucratic conglomerate it's just overburdened by costs, and as long as I've been following it, I've never thought it's been well run. And I mean, it's sitting on a lot of gold in the ground, which it's depleting faster than it's replacing, meaning that it's mining its gold at a faster rate than it's replacing its reserves, and that's a problem that the biggest mining companies have. And so, if you're of the opinion that gold is going to go a lot higher, you might want to, and you don't want to take a lot of risk. You're probably going to say, oh well, let me look at one of the large cap companies like Barrick or Newmont, because it's going to go up with the price of gold. It's kind of like a rising tide floats all boats. But in terms of, I just don't think, in terms of investing your money in the sector, I think it's very poor relative value. And, the well-known Stanley Druckenmiller found this out the hard way. He loaded up on Barrick shares in the first quarter, and they announced their earnings, and they disappointed, and the stock got hit, while some of the smaller cap stocks were rising and rallying. So, just my summary for Barrick is, again, while it's a way to index the sector, if you think gold's going higher, I want to look for the companies like Barrick and Goldcorp are going to acquire, because I think that's where the real upside is. But having said that, and again, just so everyone knows, this was on no notice, so I'm just kind of jumping into going through Barrick's financials and their latest quarter on the fly here, because I haven't
I actually wanted to surprise you. I wanted this live analysis. You can do the research as we speak. This is live, uncut, and it's while we're recording this, I'd like you to go inside and tell us a little bit about the type of numbers you're looking at. What are the key factors that you're researching as we speak, that you want to see in favor of them, or that are confirming the analysis that this has too many moving parts? Sure, absolutely. And again, just I want to preface this with, Barrick was is a company that hedges its production. Now they came out at the Denver Gold Show in 2009 and said that they had removed all their hedges, and it actually wasn't correct, because they have mine-specific hedges in place, and where this is a problem is if the price of gold starts to rise rapidly, they're going to lose a lot more money on their derivative hedges than they'll make pulling gold out of the ground and selling it. So, I mean, the lesson there is, if you want exposure to gold and you want to leverage that by buying a mining company or buying mining shares, you're not going to get that leverage by buying something like Barrick or Newmont. And I will say they did remove most of the derivative bombs that had the potential to blow it up, but it's not correct for them to claim that they're free from derivatives. And the other problem with Barrick is that it's been working on trying to get the Pascua-Lama mine down in Argentina started forever, and it's potentially make a lot of money, but they keep running into problems with it, and they keep spending money on it, and it's turned into a black hole. And I don't know if they'll ever get it started up, but it's a cash drain for them. So when I'm looking at Barrick's numbers, let's just say, okay, well, let's see how Barrick's doing. So the first thing I'm going to do is I will go to its latest earnings release, which is their first quarter that they just released a couple weeks ago, and I'll look at their statement of operations and cash flow on their balance sheet. And when I go and I look at Barrick's, give me one sec. Here we go. Okay, so their revenue was up 63 million over the first quarter of 2016. And, given what the price of gold has done, I think what happened when Barrick reported is they missed their numbers in terms of the amount of gold the market was expecting them to produce, and it is showing up in their revenue line. I mean, it's $63 million. It's a negligible increase, and yet their costs increased. They went from 1.324 billion to 1.342 billion. So the costs were higher. So that means their gross margin. It means the profitability of just their mining operation went south a little bit versus the first quarter of 2016. And then in a company like this, in a company like Barrick, that was the size of Barrick, what is the role of the CEO? Does he have a lot of people that he delegates work to? What does the CEO do every day for this kind of company? Well, that's a good question, because with Barrick, no one's really sure. The current CEO and chairman is a former Goldman Sachs partner, and I have no idea how this guy ended up running this company. I think for a company this size, the CEO is largely an ambassador, and goes around and works the various legislatures in the various countries where they operate to try and get deals and push through new mining opportunities and things like that. Other than that, if you're running a company like Barrick, your best strategy is to find the best geologists and mine operators you can and delegate as much as you can. Company pays dividends, right?
I think it pays a dividend. I mean, you wouldn't necessarily buy a company like Barrick or Newmont dividend. You're buying it for the leverage to the price of gold.
Sure. So, why does a company like that even pay out a dividend? Why not take the cash instead of distribute it back to the shareholder, put it back into new opportunities? Can this kind of company in 2017, can they not find good projects to take over?
Well, I think part of the problem with Barrick right now is that it suffered a lot of body blows when the price of gold dropped from 1900 down to below 1200, and it suffered a big body blow with the Pascua-Lama project. And Barrick, I think, was in a mode for a while where it was just conserving cash so that it could, try and right the ship. So, but yeah, I mean, they should be out. What they should be doing is out making acquisitions, and because right now junior mining companies are historically cheap relative to the potential assets that the good ones have in the ground. And if you look, there's companies like Goldcorp are out there, and they're investing in and they're acquiring junior mining companies. And I think Barrick is still licking its wounds, and it's missing out on a big opportunity. But yeah, that's the way these companies are going. The big companies like Barrick, the way that they're going to replace the reserves that they're depleting on a daily basis is to go out and acquire junior mining companies that have demonstrated that they've got gold or gold mineralization in the ground. Because
what would be the biggest expense for a company like Barrick? Is it the oil? Is it the energy component of running everything?
In terms of cost of sales, yeah, the cost of energy is about 50% of the cost of mining. That's
a lot.
But
are they enjoying? Is this the golden time? This is a pretty good time for them in terms of oil prices. What would happen if the oil prices goes up like 30-40%?
Well, that's a really good question, and I would assume they have a hedging operation in place that sort of insulates them from volatility in the price of energy. But that's a good point. I mean, companies that, and I don't have, it'd take me some time to go through everything and figure out exactly what they do to insulate themselves from input costs. But yeah, I mean, if they're not adequately hedged against the cost of energy, and the price of energy spikes up, it's just going to crush their profitability.
Okay, now let's talk about wages for a minute. What's kind of the average wage for the workers, the miners, the people that do the actual labor?
That's a good question, and it's not something that I've really ever evaluated because I have companies. However, I would say that it's going to be country specific. And a lot of these countries, especially the south of the U.S. border, all the way down into Argentina, a lot of these countries are very mining friendly, and they're an inexpensive source of labor for a company like Barrick. So it's safe to say that they're paying a lot less in wages at their mines in South America and Mexico than they are at their mines in Nevada or Canada.
Sure. Now, so what's the incentive to explore then in North America, or to buy a North American asset as opposed to a South American asset? I mean, oil prices would be the same in both countries, relatively speaking. What would be something that will entice CEOs to go into more wage-intensive areas than countries that offer them cheap labor? Is it the grades? Is it the? What would make CEOs or mine builders, mine operators, the managers seek out countries that have higher wages and more costs that are related to the labor?
That's another good question. I'm not sure that if you're a gold mining company and and you think there's an opportunity somewhere, I don't think you're going to be worried about the cost of labor per se. I think you're going to be worried more about the cost of developing a potential property, and you're going to be worried about the cost, the political risks in any specific country. Excuse me.
Sure.
And we saw that with Venezuela in the mid 2000s, and I can't remember the name of the company. There was a company that operated down there that had a huge gold mine, and Hugo Chavez said he wasn't going to nationalize it, and ultimately that's kind of what ended up happening. So I think political risk is going to be a bigger deterrent than what you're going to have to pay in wages, because if you can go in somewhere and find a property that has a lot of gold that's economical on it, and the price of gold moves higher, you're not really worried about labor costs per se, because you're going to make so much money pulling that gold out of the ground over and above your all-in cost of mining that you're not going to worry about just the labor cost component of it. You're probably going to worry about the energy cost, but that's something that you know about, and there's ways to hedge it.
Sure. Now, when Barrick or or Goldcorp, when they buy an asset from a junior, how soon do they want that asset to become a producer? I mean, they're not looking to buy anything that takes 10 to 15 years. They're looking to buy short-term, right? Near-term producers.
That's correct. Again, there's always, you can sort of estimate how long it's going to take to get a property that's been advanced into the actual mining stage. But let's say that, a perfect situation is where you can buy a junior miner that has a proved resource, that has a source of energy, a source of labor. You buy that company, and then it's just a function of going in and building the mine. And the mine build out, again, and that's a sliding scale. It depends on if it's going to be an open pit mining operation or if it's going to be an underground mining operation, because it takes a lot longer and a lot more capital to put in an underground mining operation. So, but if you go in and you buy a junior that has all of those ingredients in place, then you're probably looking at anywhere from, probably a year to 3 years before you're up and running. If it's open pit, it's going to be pretty quick, because all you need to do is have a processing facility, and you can start shoveling ore out of the ground.
When you speak to to people that are running these companies, the people that are in the field, when you do mine tours, there's such a lack of new discoveries in the gold sector. I mean, there hasn't been a major discovery in such a long time. Properties take so long to become producers, and the grades are also becoming lower and lower. What is going on right now? Where are we in this cycle, in this discovery cycle? Where do you think the opportunities will come from? Because there's such a lack of new production coming online.
Sure, that's another great question. Real quickly, I just wanted to circle back, because I was looking for this number in Barrick's financials, because I think it's a very illustrative number about comparing a company like Barrick versus a smaller producing gold mining company. And they have their cost of sales related to gold production. So that's going to be the actual mine labor, the energy, etc. And for Barrick, this is on a per ounce basis. And for Barrick, in 2017, in the first quarter, their all-in cost of production was $1,238, and that was up $32 an ounce, or $36 an ounce from the same quarter in 2016. And then you go down into something called all-in sustaining costs. Now, the total cost includes amortizing the expense of developing that property into a mine. But the all-in sustaining cost was a little over $1,000 versus $924 in 2016. So for me, it raises my eyebrow when I see their all-in sustaining costs going up. Now, the all-in sustaining cost would be the cash cost per ounce to get the gold out of the ground. And then it would also include the amount of capital expenditures that you have to pour in on an ongoing basis to keep that mine operating.
And Dave, what is kind of your benchmark? I mean, what are you looking for when you buy producers to be that sustainable in cost?
Well, there's some companies that I cover in my mining stock journal, and they're smaller. Granted, they're a lot smaller than Barrick, but they're all in sustaining costs for gold are anywhere from $650 to $800 an ounce. So you're talking about 20 to 30. Right, exactly. Well, 650 is probably going to be on the low side, but $700 to $800 an ounce is pretty standard for a really well-run, small-cap producing gold mining company. But what this is telling you is that at $1,200 gold, Barrick's taking $200 an ounce down to its operating profit line, versus a smaller company that's taking more like $400 or $500 an ounce, because that's where the leverage is in the price of gold is in keeping your fixed costs as contained as possible. And I don't want to defend Barrick, but it is more expensive to run a company like Barrick than it is a smaller cap gold producer, which is why I tend to prefer the smaller cap gold producers. But to go back to your other question, refresh my memory again, because it was a good point.
Sure. I was talking about the lack of new discoveries, the fact that projects take so long now, and what are kind of the opportunities around that, and what do you think that is?
Well, the big gold mines that had been discovered over the last, say, 100 to 200 years, and a lot of these gold mines are mines that Barrick and Newmont own. I mean, they've been largely mined out. They've been high graded out. South Africa one time used to have the biggest gold mines in the world and was the biggest gold producer in the world. And I think it's only third or fourth now on the list. And to me, that's emblematic of the fact that the big, large mining conglomerates are kind of have stagnated. And what it does is it really means that the companies that are out there developing and exploring smaller sized deposits, those are the ones that are going to become infinitely more valuable if the price of gold does what we all think it's going to do, which is move a lot higher. Because whereas historically maybe a big gold mine had ore that had 10 or 20 grams per ton. Now a high grade mine's considered between 5 and 10 grams per ton of gold per ore. So and the size of the discoveries are a lot smaller. And so again, this is going to shift the investing focus on the emerging producing gold companies and the junior companies that are out there exploring for smaller deposits, yet deposits that can be economical when gold is trading where it's trading now, and certainly a lot more economical if it's higher. I know, and I don't know if this is the case with Newmont anymore, but I know they used to never look at a property unless they thought there was at least 5 million ounces on it. And I think, just because of the fact that all the large properties have been picked over and largely discovered, I think that's kind of an archaic way to look at this. Goldcorp, I think they overpay for the companies that they acquire, but at least they're out there trying to do something about it in terms of replenishing their reserves. I think companies like Barrick and Newmont have so many internal operating problems, and they also have political problems in a lot of the countries where they operate, that I think they're missing an opportunity right now in terms of going out there and buying up these smaller companies that have, they're smaller resources, but they're very profitable at $1,200 gold. And the companies that are out there acquiring them are the ones, if you have to invest in a large cap company, they're the ones that'll have a competitive advantage over the Barricks and the Newmonts going forward.
Dave, look, I'd love to really thank you for taking the time to go in depth with us about the Barrick and everything that's going on with the majors. Again, this was not a sell recommendation. This was not a short recommendation at all. This was just a way to pick the brain of Dave Kranzler of investmentresearchdynamics.com, and just a way for us to learn more about what he's looking at when he does an analysis. And Dave, where can people? Obviously, anyone in the gold sector should be looking at your blog. Plug us into everything that you're doing, please.
Sure. Well, I published the investmentresearchdynamics.com blog, and I try to post fresh material on there on a daily basis. And then from that website, I launch my mining stock journal, which is it's a subscription service, and I focus on more the junior exploration opportunities that are out there. But I'm also going to start adding in some of the smaller producing companies, because they're still very cheap relative to where I think they should be trading, given where I think the price of gold is going. And then I also have a publication called the Short Sellers Journal, where I come up, I do an in-depth analysis of what's going on in the economic and political system. And I present a couple of ideas for making money on the short side. And I think what a lot of people don't realize is that, the Dow and the S&P seem to keep moving higher, although they've been largely going sideways since the beginning of March. But there's a lot of stocks out there that have gone down a lot in the last year. Sears Holdings being one of them, which was one of my short recommendations when it was just below 12. It's trading at 780 now. So that's my stuff, for better or for worse.
Dave, thank you very much for coming on the show today.
Thanks for having me on the show. I really appreciate it. It's good to be here.